Thanks everyone for joining. I'm Richard Hickman. I manage a fund, a listed investment trust called HVPE, HarbourVest Global Private Equity. And we are an investment trust that specializes in providing exposure to private companies, as opposed to most investment trusts that invest in public companies, i.e. those listed on stock markets. So I want to start by providing a scene setting slide here really. We are a company that's been listed since December 2007, so more than 17 years now on the market. We've grown our assets in that time from $800 million at the IPO to $3.9 billion today, having also paid out $200 million along the way to shareholders. So we have not raised any capital since the IPO. That's purely the return on opening assets that have been invested and reinvested over that 17-year period. At the top of the slide, you'll see a couple of lines, and I think the second line is the best summary of HVP really. We provide global exposure to companies not listed on public markets. It's a very straightforward proposition. There's plenty of complexity if we delve into the detail, but ultimately the USP of our fund is that we're providing exposures that the vast majority of investors would struggle to replicate themselves. So you cannot simply, go and invest in some of the leading private companies like Databricks, for example, in the AI space. Those are private, and so you'll need to come through a listed fund like HVPE to gain exposure to that sort of opportunity. And we actually provide exposure to more than 1,000 private companies, including some very exciting venture capital names in the technology field. But we have a very diversified portfolio spanning all major regions of the globe and multiple sectors and levels of maturity in the underlying businesses. So we're a FTSE 250 company. We joined the index in 2015, and we've climbed steadily over that time as the share price has risen and the market cap has grown to a position of around 50th today, with a market capitalization of £2 billion. Now, I'll come on later to the thorny topic of share price discounts, which was mentioned earlier. But nonetheless, we do have a wide discount, but the return that shareholders have actually achieved if they've held for 10 years is still impressive. It's 227% over that time, which is enough to place us in the top 10% of all investment companies with a 10-year track record. And that's been driven clearly by the performance of the underlying assets. Net asset value has grown by 13% per year in US dollars. And that represents outperformance of the public markets as measured by the FTSE All World of 2.7% per year. Now, typically, throughout our recent history at least, that rolling 10-year outperformance has tended to fall in the range of 3 to 5%. So we're actually at the lower end of where we normally find ourselves. That is due to primarily to the very strong gains in public markets in the last 18 months, and clearly in the last few days, they started to edge away slightly. So we might see that figure start to improve through a mix of our own NAV performance accelerating and potentially the public markets not doing quite so well. So I'll give you a quick insight into the team. Unlike probably most of the funds here today, we are a very diverse group. We don't have a single portfolio manager. I'm the closest thing there is to a single individual that manages the fund, but I should stress I'm one of 4 on our investment committee in the middle of this slide, which does include John Toomey, who's the CEO of HarbourVest Partners, a large asset manager that serves as the sole manager of HVPE. Greg Stento is the CIO, the Chief Investment Officer. Carolina Espinal is head of European primary investing, so she is responsible for selecting many of the funds that we feature in our portfolio. We have a board of independent directors, 5 directors with no connection to HarbourVest. They are responsible ultimately for the returns to shareholders. and are drawn from a variety of backgrounds across public and private markets. And then I lead a team day to day in London who focus 100% of our time on the listed investment company. And we're supported by a firm that has 1,300 employees and 245 of those being investment professionals. So on the next page, HarbourVest Partners, our investment manager, is a global private market specialist with a track record spanning more than 43 years. We invest only in private market opportunities. There's no public investment side. And we have 14 offices around the world with, as mentioned, a very broad and deep investment team managing the underlying assets. So we invest across various different types of private markets investments. So we commit directly to new underlying fund opportunities. We purchase portfolios on the secondary market, often at attractive discounts to NAV, and we invest directly into underlying private companies. We have a real edge in terms of information flow because we have a database with tens of thousands of underlying private companies represented, and the wider firm beyond the listed fund manages $138 billion of investors' capital. So we're trusted by institutions around the world. Now, a quick overview of the portfolio. Clearly, with the complexity of our offering, there won't be time to go into everything, remembering we have more than 1,000 companies, but I'll try my best in the time I have. So we have, at the top left of this slide, a breakdown of the stage at which we invest. So I mentioned earlier we have significant exposure to early stage technology companies. That's featured as the venture and growth equity exposure at 30% of our portfolio. And that's really the exciting, the racier side of the portfolio where there's that potential for real outperformance. But we also have a very large exposure to buyout investments. Now, those are more mature private companies, generally speaking, where the underlying managers through which we're investing, they effectively acquire a majority stake in those underlying private companies. And so they're very active in driving value and helping to professionalize and grow those businesses. And then finally, we have private credit and infrastructure with 8% of the portfolio. That is clearly a smaller exposure. That's designed to provide risk-adjusted, very attractive returns with a component of yield, which helps our cash management and helps to act as a hedge to some degree against those higher volatility early stage companies. So the idea is we're trying to provide a very steady but very strong annual return through a mix of private markets investments. And then I'll skip over the middle pie chart to the rightmost chart, which shows the geographical weightings. So we are approximately in line with the global public market index, albeit we are not quite at the weighting in North America that the public markets have reached. The FTSE All World Total Return is now 70% US. We are 61%, including a small amount of Canadian exposure. We have 22% in Europe and 15% in Asia Pacific. So we do provide that geographical mix to ensure that we are not overweight any given region. And in fact, we've seen Europe in our portfolio outperform the US in the last 2 years, partly due to the fact we're investing in small and mid-cap companies, of course, in private markets that have performed very strongly. Then by sector, the lower chart here, you'll see 33% in technology and software, which does include AI-related opportunities. We have consumer, medical and biotech, financial, all represented between 13 and 14%. And then the smaller sectors, industrial, business services, media, telecom, and energy make up the rest of the portfolio. So a very broadly based, again, well-diversified exposure by sector. Now, a hint of what's in the portfolio, and you'll have heard me say we have 1,000 companies. Clearly, that means there is no single company that really dominates the portfolio, and so company-specific risk is very limited. Nonetheless, we have one relatively large holding by our standards, which is Shein at 2.2% of NAV. That grew out of a portfolio of companies that we acquired some years ago and has been an extremely rapidly growing business. So it's effectively emerged as our top holding. You may have read about that in the press. The rumours are the truth is it's looking to IPO in the UK, and we'll see how that goes. But below Shein, there are many interesting opportunities here, even just within the top 10. And you can see from some of these names the lack of correlation in the portfolio. We do try to build, very, very diverse ranges of companies in the portfolio. So we have a specialty financial provider, Preston Hollow, in the US. We have a ports business in Australia in the infrastructure portfolio. We have a discount retailer in the Netherlands in the bio portfolio. You're getting the theme here. And probably some of the better known names, we have Revolut, that's emerged as our number 5 exposure, sorry, number 6. We have Scale AI, which has just joined the top 10 recently. That sells the data on which large language models are trained. So in some sense, it's really a picks and shovels play on the AI trend. And I mentioned Databricks as well, which is an enterprise software firm that is also using AI to better serve its customers. So I'll be very quick now with 2 minutes to go. This is a chart that shows the NAV per share performance in terms of the blocks here, and the share price in the green line. And you'll immediately see the gap that opened up really post 2022 in earnest between the share price and the NAV. So currently we are at a discount of 35% to NAV versus a typical range of 15 to 20% prior to COVID. We think that's partly due to the fact that listed PE is frankly being overlooked. Our sector providing exposure to private markets is not one that many investors are focused on or have real knowledge of. So we're trying to change that and promote the fund much more actively. And we also have 3 initiatives that we announced recently that could help to bolster shareholder returns going forward. So very quickly, we are now allocating 30% of the cash that we receive from maturing investments being sold or liquidated to a pool that we're calling the distribution pool. That is at the moment being used for share buybacks. So the cash that's coming from those successful portfolio sales is being partly allocated directly to purchasing the shares at a discount, which clearly is accretive for remaining shareholders because the number of shares falls, but the NAV doesn't fall as much. And also it helps demand for the shares. We are simplifying our investment structure. I haven't had time to explain how we invest in terms of the structure so far, but we're going forward simplifying our portfolio construction considerably, which should help investor understanding and help clarify our messaging. And also we have finally a continuation vote scheduled for the July 2026 AGM, which gives all shareholders a say in the future of the company. So we hope that that helps to really draw a line under any prospective widening of the discount. So with that, I'll finish. My time is up, but I hope that was of interest. We have our own website, hvpe.com, with much more information, including the full presentation that I haven't had time to run through in 15 minutes. And I'm sure I'll see some of you at a future AJ Bell event as well. So thank you for tuning in.